Welcome. I think we have a critical mass now. Hello, everyone. Thanks for tuning in to today's Green Bank Network webinar on financing resilience. My name is Sarah Doherty, and I'm from the Natural Resources Defense Council. As a reminder, attendees are in listen-only mode, so please insert your questions into the questions box in the GoToWebinar control panel, and we will answer them towards the end of the webinar. Also, we'll be sending out and posting a recording of this webinar in the next day or so. To start out, for those of you who are not already familiar, the Green Bank Network was formed in December 2015 to foster collaboration and knowledge exchange among green banks, and also to serve as a source for knowledge for jurisdictions that are seeking to establish a green bank. Our members are on the screen, 6 members across 6 countries, and NRDC, along with its partners at CGC, serve as the Secretariat. While we're here, a quick definition of what a green bank is. Green banks vary in how they're structured and how they invest, but at their core, green banks are generally publicly capitalized entities established specifically to facilitate increased private investment into low-carbon, climate-resilient infrastructure, what we often call green infrastructure. And this includes clean energy as well as water and waste management. The Green Bank Network webpage, greenbanknetwork.org, has more details on what green banks are and what they do, including reports in English and Spanish in our new En Español tab, and webinars including this one. I'm also a part of NRDC's Center for Market Innovation that focuses on how markets and investments can help us tackle our many environmental challenges. This work includes our green bank work, but also work in green bonds, stormwater finance, energy efficiency for affordable housing, and more. Today, we are lucky to have 2 great experts in resilience finance for a discussion on the challenges for resilience and concrete ways to integrate climate resilience into investment. Josh Sawislak is an internationally recognized expert on climate and disaster resilience and sustainable development. He advises governments, corporations, international organizations, and NGOs on policy implementation and financial issues around building sustainable and resilient infrastructure in both the developed and developing world. He recently led climate resilience efforts for a large global infrastructure firm and served at the White House in the administration of the U.S. President Barack Obama, leading the climate adaptation team at the Council on Environmental Quality and infrastructure team of President's Hurricane Sandy Rebuilding Task Force. He serves as a senior advisor to the Center for Climate and Energy Solutions and as a professional affiliate at the Center for Urban and Environmental Solutions at Florida Atlantic University. Stacy Swann is the founding member and CEO of Climate Finance Advisor and has more than 2 decades of experience in finance, fund management, and development, including the World Bank Group and the International Finance Corporation. CFA's team consists of bankers and financial professionals with expertise in international development, finance, sustainability, and climate change, and has deep expertise in climate-related development, including renewable, climate-smart infrastructure, and adaptation. Josh will discuss the broader market challenges for resilience, including value capture from both his experience in the Obama administration and the private sector. Stacy Swann will discuss her recent joint publication, Lender's Guide for Considering Climate Risk and Infrastructure Investing, and ways green and resilient banks can boost investment in resilient infrastructure. Before turning over to them for a deep dive into financing resilient infrastructure, I'll give us a couple of quick perspectives on why this subject is important to all levels of market participants. As credit ratings have huge impact on borrowing costs for government, Moody's environmental risks, evaluating the impact of climate change on the U.S. state and local issuers, highlights the importance of resilience for keeping borrowing rates down. As this is very important, I will give you their exact words. It will be a, quote, growing negative credit factor for issuers without sufficient adaptation and mitigation strategies. They give the example of New Orleans that had a A3 stable rating before Hurricane Katrina. In the months after, they downgraded New Orleans' credit rating. There was widespread infrastructure damage, dramatic decline in the city's revenue, and a significant share of the local population left and did not return. So now, Moody's analysts weigh the impact of climate risk with states and municipalities' preparedness and planning for climate risk when analyzing credit ratings in advance of storms like Katrina hitting. Also, it affects corporate earnings. S&P just last month released a report showing the effect on publicly traded corporations, showing the impact of weather events on earnings. Some of the highlights of the report are that in fiscal year 2017, 73 of S&P 500 companies, 15% of the total, publicly disclosed and effect on earnings from weather events. Only 18 quantified the event, but of those that quantified, it had a significant 6% effect on earnings. This is a growing topic of interest among CEOs and management teams. The impacts are being felt across sectors, geographies, and seasons. To dive into what we need to do about this, now I'll turn it over to Josh.
All right, thanks, Stace. Thanks, Sarah. The next slide's got some information on C2ES. As she mentioned, I've recently joined C2ES as a senior advisor, but I don't really want to spend a whole lot of time. Oops, we got everything. I want to spend time talking about resilience and risk in infrastructure investments. So let's go on to the problem statement slide. Great. You know, I've worked in public and private infrastructure for over 30 years, and the early part of my career was mostly in the US. And we've got some infrastructure here that's, 50, 100 years old. But a couple of years ago, I was in London, and I was working for a big infrastructure firm, and we were doing some of the planning around the renovation of Westminster Palace, the home of British Parliament. And they were kind of walking us around and showing us the building. And one of the guys notes that in 1834, a fire destroyed most of the original buildings. And so what they refer to as the new parts of the palace are almost 200 years old. Then they walk us into Westminster Hall, which is where monarchs and Churchill and a whole bunch of other people will lie in state. And Westminster Hall, which is an amazing place if you've ever get a chance to go there, it survived the fire. And so it was built in the 11th century. So I think we can probably all agree that some infrastructure is really a long-term investment. And investors and communities both see infrastructure as a long-term asset. One of the things that's impacting this and is really a change in the market is what's happening with climate change and other perils, physical hazards. They are really changing this asset class because we have to start to look at how we better price that risk. There was recently, as part of the Financial Stability Board, something called the Task Force on Climate-Related Financial Disclosures. And probably half the folks on the webinar know much more about TCFD, as it's colloquially referred to, than I do, and half of you think it's a really long acronym and you're not sure what it means. So I'm not going to talk in detail about it. I'll talk a little bit about it, and Stacy's going to talk a little bit about it in her section after me. But what it basically is a group from both the companies that are generating the information around what the assets are, how they're being impacted by both physical and the transition to low carbon risk, and then as well as the people, the investors, the banks who use that information. And they've kind of gotten together and come up with an approach to how do we disclose climate information in a way that is useful to the market. And the approach is around scenario analysis. And there's probably 5 other webinars that just talk about that, so I won't go into a whole lot of detail on it. But I want to make the point that the capital markets are learning how to better price climate risk, because climate risk is a longer term risk. We talk about weather is what it's like out today and what's going to happen later this week, and climate's what's going to happen over the longer term with that weather. And this really presents a challenge to investors because it is a more difficult thing. There's a lot of uncertainty in climate, but there are also a lot of opportunities, and I'll talk a little bit more as we go on about some of the opportunities in risk transfer and why that can be valuable as a way to capture some of the value as we start to look at how to invest in a more resilient future and more resilient infrastructure. So let's go to the next slide. The point that I generally like resilience is that it is a relative term. You have to be resilient to something. Energy efficiency, reduction is real easy, and my friends in that field get mad when I say that, because it's probably not as easy to be this morning, but it's easy in the sense that it's not difficult to measure. There's a sign, you have a metric, X minus anything is good. You decide how much of that you want to buy. It's pretty straightforward. But resilience is a relative term. You have to figure out what you're resilient to. And let me make a confession here. I am a total nerd, and of course I own the Oxford English Dictionary, and I looked up the word resilience because it traces the word usage. And according to the OED, the first reference to resilience is in the 17th century. Francis Bacon, in a treatise on natural history, uses the term to describe the physical characteristics of an echo bouncing off a wall. So resilience literally means to bounce back. It is not a mitigation of the bad thing that will happen. As my former Obama administration colleague Craig Fugate likes to say, resilience doesn't mean bad things won't happen. It means you survive them. So when we think about this, we're really thinking about risk. And so let's go to the next slide and talk a little bit about risk. We have to understand risk. And I'm going to spend a couple of minutes here talking about risk, and I'm going to mostly talk about physical risk because I think that when we try to figure out how to make the business case for investments in resilient infrastructure, we have to understand why, and it gets back to that being resilient to something. And you have to understand risk to manage it. And so one way to think about it is, what are the components of physical risk? So you have threats, you have assets or systems, and you have vulnerabilities. And the threat is the thing that does the bad stuff, like a hurricane or an earthquake. The asset is the thing you're relying on to work. So in the hurricane scenario, let's talk about a electrical transmission line. So it's not the supply of electricity, it's the asset is the line. Now the vulnerability is the disruption of that asset and how the threat can disrupt that asset. So in the case of the hurricane winds, if the hurricane wind knocked down a tree, which takes out the power line, now you actually have defined that risk. And so it's a formula, right? Risk is the threat to vulnerable assets divided by the probability. So now you got to understand all of these things: the risk, the asset, the vulnerability, the probability. When you start to do that, and this is of course what CAT modelers do for firms that do that, and insurance companies and all sorts of folks, you can start to figure out how to price that risk. And it's an interesting approach to really look at it as it's a math problem, but it's a little more complicated because there's a lot of uncertainty, and I'm going to talk a little bit about that as we go on. But before I do that, let me talk for 1 second about one of the things that I hear all the time in the kind of infrastructure resilience space, which is that all we need to do is come up with some creative financing and we can solve all this, right? We need trillions of dollars. If you like McKinsey's number, I think it's $60 trillion in the next 20, 25 years for infrastructure globally. OECD's number, I think, is closer to 100 trillion with a T. And, you know, the issue is not a financing issue. And Stacy's going to talk a lot more about financing. But what I think the challenge is not that there's not capital to do this, because there's lots of capital in the market that's looking for stable long-term investments. It's that there's not money to pay back that financing. And that's why this value capture issue, what is it worth? Why should we invest? What's the business case is really important. And in order to make that business case, we have to understand what it is that we're trying to protect, what those assets are, what the value of the service they provide, and what the impact to loss ratio is. What happens if that's not available for, and it's a time period, right? So you can do without something for a short period of time. You can do without food for a short period of time, but you can do without water for a shorter period of time. You know, it used to be you could do without your phone for a while. Now I think that the recovery time objective for your cell phone working is measured in nanoseconds. Everybody freaks out if their phone isn't working or the service isn't good. But we have to understand those things in order to make the business case. And we have to do that both as communities, we have to do it as companies, and the market, both the political market on the kind of public side and the capital market. And that's happening in part because, you know, as I said earlier, the market's starting to better price that risk, and people are understanding that they need to invest in more reliable infrastructure, because infrastructure is those things that help that serve us all, and the interconnectedness of the infrastructure. During Hurricane Sandy in the New York region in the U.S., 2012, we had a lot of impact to wastewater treatment plants, to the sewage plants. Most of it was because they didn't have power, not because there was physical damage to the plants. And so the interconnectedness between the electrical service and the ability to treat wastewater and to supply drinking water, transportation systems don't work. Again, they might need power, they might need people to get there to operate them, they might get flooded, all sorts of things, and the interconnectedness of these things is real important. Another big issue that we face is around data quality and uncertainty, especially when we're talking about climate risk, because while we know that climate change is happening, there is very little actual scientific debate on that, even though there's a lot of political debate in the US. There's, when you actually talk to scientists about this, it's, climate change is happening, you can measure it. How quickly it will happen and where the impacts will be at a granular level is much harder to determine. We know in broader terms what's going to happen. We know that storms will be more frequent and more severe, but whether or not what the wind speed is going to be at a certain location at a certain time is something we don't know, and how quickly sea level rise will happen and where it will be most prominent are things that we have very, very good ability to model, but there's still a lot of uncertainty in that. And while the data are getting better and better, and the models are getting better and better, we don't know in the short term, we don't have a sense in the short term that we're going to be able to just solve this problem and have perfect visibility on what's going to happen. The other issue that affects this is kind of looking at an investment horizon versus a useful life. And with short-term investors, and I used to work for a big public company. We reported to Wall Street every 13 weeks. So There was a lot of time spent talking about what's going to happen in the next quarter and what can we tell Wall Street in the next quarter. But when you're a company and you're building a manufacturing facility, let's say for an airplane, you'll build that airplane for 20 or 25 years. And then you're going to make parts for that airplane for another 15 or 20 years. So the factory, which is very expensive to build, it has a useful life of 40, 50 years. That's an important thing, and that's within the time horizon where climate change is going to have an impact. So it's an important thing. What you have to report in the next quarter is not as tied to actual changes in climate. It may be to disasters, if a disaster happens in that time frame. But that's where some of these disclosure issues are starting to make a little bit more inroad in the investment horizon of institutional investors is longer. I have a ongoing argument with a friend and a colleague of mine who says all investors are short-term investors, because even institutional investors will get out of the deal if it's not a good deal. And while I agree that that is true, they are looking for and are willing to invest in, if you'll excuse the pun, longer term investments, because that is, what the structure of what they're trying to do is. So I think it's for communities, that investment horizon is long term as well, because that infrastructure, again, has a long useful life, and it matters what happens over the life of the community for you and your family and the next generation. And all of this really goes into how you price that risk. So it's important to understand that pricing the risk and capturing the value of the risk reduction. This is the hardest part of the business case around investing in resilient infrastructure, is how do you value an avoided loss when you don't have clarity on whether or not it will happen within the time frame. We do this a lot with insurance, because we buy car insurance or life insurance, and we don't know if something bad is going to happen within the term of that insurance, but we're transferring that risk. And we have to really look at this as a kind of risk management approach, and start to value more resilient infrastructure, both as a community, which I think we're better at right now, but also as companies, understanding that we have with the cascading effects and the interdependencies, the ability of a company to, let's say, make money is affected by things that happen in other places, especially as we start to look at global supply chains, how employees are, what happens to them at home, their house, the school for their kids, their ability to get to and from work affects the ability of the company to make money. And so we have to look at this a little bit more holistically. Let's go to the next slide and we can talk a little bit more about the opportunities. As I mentioned earlier, risk provides opportunities. Of course, this is really the whole basis of the insurance industry, right? So it's about risk transfer. And I'll talk more about that in a minute, but let's talk about how we embrace risk. And the best way to think about this is an enterprise risk management model. So you have three choices in enterprise risk management. You can mitigate risk, you can transfer risk, or you can accept it. But you've got to pick one of them. And of course, it's usually a combination of the three. You will note that ignore is not one of the choices, as that's really a default for accept. But if you ignore the risk, if you sweep it under the rug, then you have accepted that risk, but you've done it in a really uninformed way. And so I think it's important that we understand that we do have to be positive and active and really understand what we're doing. And of course, we do this, every day. We do it for physical risk, and we do it for financial risk. For example, I have a motorcycle, so I accept a lot of risk. But I wear a helmet, and I have clothes and boots and things that I wear when I ride the motorcycle. So I've mitigated some of that risk. I don't ride when it rains. I don't commute on it. And there's a bunch of things I do to mitigate that risk. But I also have insurance, right? So I transfer some of that risk, the risk of me being hurt. I'm still assuming a bunch of risk. And that's really how this works for any type of risk management. Let me talk about non-correlated risk for a second, because this, from an opportunity perspective, is really a big thing. And one of the things that we hear about a lot these days, or at least if you hang out with me, I'm at in Denver for the Natural Hazards Workshop at University of Colorado. One of the things you hear a lot about is parametric insurance, sometimes called catastrophic insurance or CAT bonds, catastrophic bonds. It can be either an insurance policy or you can do it as a financial instrument. And the reinsurance industry has gotten really big on this, in part because they can use catastrophic disaster risk to diversify their portfolios, because they can kind of segment it and look at geographically where it is, and start to use that to diversify larger portfolios. But the interesting thing about natural disaster risk is that it is generally not correlated with the capital markets. So the reason that there is an actual big business in this is because hedge funds are buying this cat risk at a premium. And that's part of this whole issue of enterprise risk management. If somebody can take that risk and manage it more efficiently than you can, you should always choose that approach. You want, in an efficient economic model, the person who can manage the risk the best is the one who should have it, and they're willing to pay more for it. I mentioned the TCFD, Task Force on Climate-Related Financial Disclosures, and I did talk a little bit about the fact that there's both physical and transition risk, and this transition risk is really the risk of both business and political risk around the transition to a low-carbon economy. So it's really more focused on what happens to assets like a coal-fired power plant as we move to a low-carbon economy. So the physical risk issues are really about the impacts of climate change. What happens with increased heat, increases in drought, more severe and frequent weather. But that transition risk is a different way of looking at that. So you're going to see, if you look at the TCFD information, you're going to see both of those things. And I really spent more time, and I will continue to spend more time in this, just really talking about the physical risk. Let's go to the next slide. So let me talk about kind of where we're going, and then I'll hand off to Stacy, who can talk a little bit more about some of the things that are happening, cool stuff. I really talked about that transparency issue. I put it on this slide because I want to make sure that everybody understands this is a sea change that is happening. This transparency, as companies start to disclose more of their climate risk, the market is going to be better at pricing it, and it's going to make a change in the way that we think about these things. We're also seeing governments and cities do that. It is a big kind of sea change in how this industry is happening. Then I want to leave you with really two thoughts. And the first one is that we have imprecise data and manage the uncertainty of both climate and politics. In the climate space, we know things are happening. We are getting better and better at modeling them, but again, we are modeling them. And we only really know what happens and when it happens. And so we have to figure out how to price that risk and value the benefit of the avoided risk in order to bring the money into this market. That's going to be the biggest challenge for us. And the politics are going to affect that. It would be great if everybody did what made the most economic sense for everyone, but that's just not how the world works. And so we have to look at this issue in the context of the both local and geopolitical worlds. The last thing that I want to mention is that both companies and communities and institutional investors have different timeframes that they have to deal with. The market and constituents, honestly, are short-term problems. If you talk to politicians, they might be up for election every 2 years, and so a long-term solution may not be a viable thing if they can't convince their constituents to do it. But we have to remember that infrastructure itself is a long-term investment, and it affects our communities in a long-term way. And so we've got to balance the time frames and understand that the business case is complicated. Just like resilience is complicated because it's relative, creating the business case for these investments is complicated because it's the balancing of the short and the long term. And with that, I will wrap it up and hand it back to you, Sarah, or are we going straight to Stacy?
We'll go straight to Stacy and just remind everyone to type your questions in the box, and Josh can answer at the end. Stacy?
Great, thanks, Sarah, and thanks, Josh. And first, let me say thank you to NRDC for the webinar and for the opportunity to present our lender's guide for considering climate risk in infrastructure investments. Should we go to the next slide, please? Thanks. So this is just a brief slide on who we are as climate finance advisors. We are, as Sarah mentioned in the introduction, we're a consulting and advisory firm in Washington, D.C., comprised mostly of bankers and private equity and financial professionals, and who have worked in both the international and domestic financing space. For collectively, we have more than 100 years of experience. Our mission is to accelerate sustainable climate smart investments and to integrate climate considerations into financial products and services and policies. And we work with both public and private clients, sometimes to think about how to develop climate investment strategies, both at the policy level, at the, let's say, government level internationally, also state level and city level. We also appraise and structure climate smart investments, both on the investor side, and also help project developers put their investments together to seek funding. And then our core strength from an experience base is really in the area of what's called blended finance, and that is that area between public capital and private capital. And we do a lot of work on how to mobilize, catalyze, and leverage public capital with private capital across all climate smart, climate related asset classes, including infrastructure. So go to the next slide, please. So we know, Josh has mentioned this, but it's a little bit of a snapshot. We know climate change is already having a financial impact on infrastructure. I won't go through each of these specifically. I'll just draw your attention to the box on Houston, Texas. So hurricane damage in 2017, mostly from Harvey, but also a few other extreme rain events, resulted in more than $100 billion worth of damage. That is a pretty big number, even for Texas, even for the United States. If you look at the box above that, the $306 billion number is the official number from the U.S. government on weather and climate-related disasters. There's a little bit of an inconsistency between that number and the $100 billion. It's not the case that Houston or the Hurricane Harvey was 1/3 of that, but it's mostly that the 306 is a number that I believe is pretty conservative and related to only those costs that were covered by insurance. Next slide, please. Okay, so I'm here today to talk about our investor guide. In January of 2018, Climate Finance Advisors, along with Acclimatize and 427, published an investor guide that was targeted towards banks specifically. Can you go to the next slide, please? And our focus really of the investor guide was really on how banks and financial institutions can understand, identify, assess, and quantify risks to help them understand their investment choices. This paradigm here talks about the risk management process, and I've grayed out the disclosure portion of this for now, but I'll make mention of the Task Force on Climate-Related Financial Disclosures briefly. If some of you are aware, the Task Force on Climate-Related Financial Disclosures, or TCFD, was launched in 2015 at the Paris Climate Summit, and it was led by Michael Bloomberg for approximately 2 years, and it was really meant to put guidance and voluntary measures around how listed equities in the stock market could disclose their climate risk. It talks about both physical and transition risk, and there's some discussion about liability risk, but our focus really in this lender guide is really if an entity wanted to disclose, how would they do that? What are the things that they need to undertake to disclose that risk? We look at the risk management side of the equation on the assumption that that is a necessary condition for any disclosure that may or may not happen. So we look at how to identify and assess the risks, how to quantify that, and then very importantly, the management of those risks is multi-dimensional. There's both physical strategies and financial strategies that a developer or a municipality or even a financial institution can take when they understand what the risks are that they're facing. Next slide, please. Our lender guide is really, it's targeted for infrastructure banks. So if you kind of have a sense of the financial ecosystem, not all financiers are the same. Banks invest mostly debt, sometimes equity, and sometimes guaranteed, but they're mostly debt providers, and they mostly come in particular infrastructure lending usually comes in to build the infrastructure project. A pension fund or an institutional investor would likely invest in an infrastructure project once it's already built. So for us, the target of this lender guide was really to say, what are the things that a loan officer or credit officer might need to think about if they're making an investment into a piece of infrastructure, either a greenfield or brownfield piece of infrastructure. And what are the things they would want to look at to assess the climate-related risks? How might that be integrated into their corporate loan pricing, both positively and negatively? And then, what might they be able to do to help that project manage and mitigate the risks? Because obviously financing is only one component. The guide has 10 subsector snapshots to illustrate how this might be applied when looking at, say, a telecommunications project or real estate or energy or a transport or ports or data centers or social infrastructure like hospitals. And if you look on the right side, you'll see that's the cover of the report, and there's a link down below. You're welcome to go download it. Next slide. We started with the assumption that there are 6 main climate-related hazards that will have an operational and financial impact on infrastructure. And those are the hazards through which we ask questions, or which we pose questions for appraising infrastructure projects that will have an impact to revenues, assets, or costs of the project. So the hazards we look at are temperature, sea level rise, precipitation and flood, storm, drought, and water stress. Next slide, please. The problem we're trying to solve, of course, is that not all financiers are the same, and banks themselves, in particular infrastructure lenders, enter into the project at a very specific time. And the purpose here is to help these financiers integrate climate risk considerations into their investments, and how the risks that those investments may face have an impact on the overall financial performance of the project, because that, of course, will have an impact on the loan performance that the financial institution makes, and could actually also have an impact on the ability to offload that loan at the point in time you might, as an infrastructure bank, be selling to a pension fund or an institutional investor. We did articulate in our lender guide the approach for both new investments and portfolio management, slightly different ways of thinking about appraising risk and then managing risk. But you'll see for new investments, it helps identify risk during project appraisal. It helps the clients put in efforts to better manage those risks. And most importantly, and I say this usually in every presentation I make, it's not just about insurance. In a lot of discussions that we have with financial institutions or financial actors, the first thing they will go to when they think about managing climate risk is about insurance. Insurance does nothing to lower the risk of an infrastructure project. It actually just transfers that risk, and not even all of it, to the insurance provider. It's definitely something that most infrastructure projects have to have if they're getting investment or lending or debt from an infrastructure bank, but it's not mitigating the risks. On the portfolio management side, really this is about taking a look at what you're holding as a bank and thinking about how certain types of climate-related risks might impact the returns of your portfolio. So next slide, please. So the costs are real. Here's a little bit of a snapshot of some of the actual numbers that infrastructure projects or that infrastructure and the economy have experienced from climate-related events. In last year, over the last decade in Texas, there were 32 quote-unquote billion-dollar storms. A billion-dollar storm is a term that the insurance industry will use to essentially indicate that the insurance industry's exposure is a billion or more. So it doesn't mean it's 32 billion. It actually just means that it's past that metric 32 times. The actual number is much greater. You'll see some of the impacts on the right-hand side from Harvey in Houston. In statewide, there was about $180 billion in total damage. These numbers are from April, so the numbers actually may have gone up. In April, certainly Houston was just recovering or just starting to recover from the damages of Hurricane Harvey, and had only at that point in time replaced all of the people that were displaced from the storms. If you think of the storm of last fall, it took that long for them to get the last folks out of temporary housing. And you'll see in Houston itself, $2.4 billion of city infrastructure was damaged by Hurricane Harvey. Next slide, please. So what problem are we? Oops, thank you. Of course, a lot of value is potentially at risk in lending for infrastructure. Josh mentioned a couple of figures from McKinsey. The $90 trillion is a new climate economy report figure. I think there's a lot of different numbers and assessments out there, but they all start with T, and it's quite a lot of assets, both at risk and potential opportunities to kind of invest and make infrastructure more resilient to the context and climate-related risks that they experience. Traditional tools to help banks assess these risks actually don't help when it comes to climate change. Most of the tools that banks use to help assess credit risks for their counterparts have to do with country risk or let's say municipal credit ratings, which, as Josh has mentioned and as Sarah mentioned in her opening remarks, credit rating agencies are starting to integrate climate risk into their ratings, but just starting. But also, technology risk or, revenue risks, none of those things are actually none of those things adequately capture climate risk in the sense or in the context of how it actually crosswalks into revenues, assets, and costs. And generalized approaches for a sector, quote unquote, also don't work. So we did 10 snapshots of infrastructure sectors, but two projects in the same infrastructure may have very different risk profiles depending on where they're located. So an airport in one city or state, let's say Phoenix, would have a very different climate risk profile, how climate-related events might impact the revenues, assets, and costs of that airport from one in Juneau, Alaska, for example, or one in Bangladesh. So there is a need to be very contextual when it comes to understanding the climate risk of a particular piece of infrastructure. So next slide, please. There's a lot of opportunity, of course. The $90 trillion number is here again, but there's a lot of opportunity to make infrastructure resilient. And it's not necessarily always the case that those resilience measures are more costly than baseline. There's also opportunities to develop technologies, products, and services that can help increase resilience, including data and analytics services. There's also opportunities to minimize resource intensity and increase energy efficiency or increase water efficiency through new technologies and practices. And I will say water, from an infrastructure perspective, is actually one of the most important things to think about when thinking about climate risk, because water scarcity and intense rains and flooding tends to have a much greater, let's say, financial impact on both sides, either drought or intense rains. And then, of course, diversifying energy sources and incorporating new technologies is also very important. So, Sarah, I have just lost the screen. Is that on my side?
I hope so. Josh, can you still see the screen? Well, I am on slide 20 if you want to speak to that, Stacy.
Okay, great. I got it. Got it back.
Yeah, I can see it. Okay. Sorry, I was on mute.
Something just not picked up. Okay. So, of course, certain types of infrastructure lending is more at risk than others. Those pieces of infrastructure projects that are in weather and climate sensitive locations, obviously low-lying coasts and areas that are affected by sea level rise, but also where infrastructure is located in areas that are where weather has a high variability, or where the occurrence of extreme weather events could have substantial impacts. And there, what we're seeing is the impact of extreme heat on not just the performance of infrastructure, but the ability of people to kind of service that infrastructure or make sure it runs. And that happens with trains, that happens with roads and airports, and a lot of urban infrastructure. Places where assets are already stressed are also places where that may have more financial vulnerability from climate change. And then, as Josh mentioned, in this country, we have a lot of long-lived infrastructure, some of it 50 years old or more. Obviously, that infrastructure was built in a time when, the temperatures and weather were less variable and the impacts, were not as extreme. And that those infrastructure assets that are aging and old, and those that need to be kind of put in place for 50 or 100 years, water infrastructure, for example, some bridges and the like. Those are types of infrastructure that might be more at risk from weather and climate change. Next slide, please. So I am happy, Sarah, to go through a little bit of an example of what we have, if it makes sense. I can go quickly. 12:52. Okay, great. So we've got a couple of slides to maybe ground this in an example. One of the sector snapshots that we did was on marine ports, and this is a global overview of the investment potential as of about a year ago. So as of about a year ago, projects in the pipeline of infrastructure banks were almost $460 billion. So that's a lot of investment. In the US and Canada, we had almost 100 billion. And you could see some of the numbers from other regions. The top is a little bit of a definition of where we drew scope around marine ports as a sector, and what infrastructure investments qualified. So next slide, please. So here's an example of how we took the hazards, which you can see by the icons on the left side, and described how they may impact your marine port investments. So I'll go through a couple of these. I won't go through all of them. And this is how they might impact revenues. Chronic temperature, for example. So gradual temperature increases may have an impact on shipping routes and could actually allow for maybe increased trade flow to your marine port if you're having more traffic coming, depending on where your port is located, if you're having more traffic coming to certain locations because certain routes have been opened up, that actually may be a benefit and may increase your revenues for a marine port. Obviously, storm precipitation and flooding. Some locations for marine ports may have to think about not just storms, but also regular inundation and nuisance flooding from sea level rise. And this is in particular, this is particularly kind of important for the transportation infrastructure that links to the port itself. If the roads are flooded on a regular basis, every full moon at the high tide, you are going to shut down your productivity of the port, and that will have an impact on your revenues. The next slide. On the cost side, temperature increases may actually raise your costs. An increased number in the temperature chronic impacts from temperature rise may result in an increased number of extreme heat days. So if you had 5 extreme heat days last year, and in 5 years you're expecting to have 15 extreme heat days, and that has a cost implication in terms of maintenance and port traffic, you may want to consider that. Next slide. And on the asset side, obviously your asset has both tangible and intangible value, but frequent disruption or damage to port infrastructure could lead to your clients going elsewhere, going to different ports and finding different routes to get their goods and services to market, and that could have an impact on your overall asset value and your ability to value yourself and or sell later on. Next slide. So I'll go very quickly on this case study, and you'll have the slides, so you'll be able to read this. But I just wanted to give you an example of how climate-related events impacted the financial, let's say, picture of the Port of Durban. You'll see on the right, on the left-hand side, a little bit about the Port of Durban. It's one of the largest ports in South Africa, and it handles a significant amount of volume. So it's got a high financial value. On the right side, though, I do want to just point out, this is a snapshot from Transnet's 2017 annual report. Transnet is the operator of the Port of Durban, It's a multi-billion-dollar company that does a lot of different transportation infrastructure in South Africa. And they have, in their annual report, they have called out how erratic weather and climate have an impact on both their infrastructure, but also their revenues and their revenue growth. So they are already starting to, quote unquote, disclose some of the influence of climate-related impacts on their financials. Next slide. So in October 2017, just about 10 months ago, there was a supercell thunderstorm. So it was not a hurricane. It was one of those intense downpours that many of us have experienced. But it resulted in the closure of the port of Durban for 3 days. And the harbor, in addition to closing the port, the harbor was, one of the ships kind of was blown across the harbor mouth, and containers went everywhere, and the harbor was shut down. Maybe go to the next slide because it's in dollars, the impact, the financial impact. These were the financial impacts. There were 3 days of forced closure, about $3.3 million in revenue. And they were occupied, they had a 90% occupancy that was stuck when the port was operating with limited capacity. So their output throughput was definitely slowed down. It resulted in 12 days of congestion and delays. And for those that were trying to send their goods and services through the port during this time, they ended up getting a $100 per container charge. It doesn't sound like a lot to us, and maybe it's marginal for some of these folks, but it was part of the way that the Transnet tried to recover some of the lost value of being down for 3 days. Next slide. Oh, that's it for me. So I'll stop there, and maybe we could take some questions.
Great. We are almost at time, so if people need to drop off, understandable, but we'll go for a few questions for those that can stay on. Our first one for both our tools available for assessing climate risk. Do you guys have any recommendations?
It's Josh. There's a lot of different stuff out there. I don't know that there's a silver bullet. There's certainly a lot of different companies that are doing some proprietary stuff. Most of the open market are going to look at it kind of broadly because as I think I mentioned, this is a pretty complicated thing. You have to really understand what your assets are, and you got to map those pretty well, and then you've got to figure out what the threats and vulnerabilities are. So there are some kind of broad level, both firms that will do this at a real general level, and there are also folks who will do this at a very detailed level. One of the things you can do is look and talk to insurers about how to transfer the risk, and as part of that process, they're going to do an analysis of what your risks are. Now, as Stacy mentioned, two things about insurance. One is it is risk transfer, it is not risk mitigation. So it does not do anything to lower your risk. And it is very focused on what risks they want to transfer and which ones they won't. So they're only going to price the stuff that they're interested in transferring. But especially insurance brokers will kind of work with you on all the different stuff out there. But there's lots of detailed modelers. Stating?
Yeah.
Well, following up on that, oh, go ahead, Stacy, please.
Yeah, I would say I would agree with Josh that I couldn't recommend one because there isn't a silver bullet. I will say, depending on what you're looking to do, you may need something different. So I would say that kind of when you're looking for a data or analytics tool to help you, the things you need to be mindful of are your time horizon. A lot of the publicly available information out there on climate risk, and U.S. government has a website that also gives you the ability to kind of do some of this. The time horizon for most of the publicly available stuff is too long term for most decision makers. It's 20, 30 years out. Most, at least from the financial sector, and kind of most banks or most entities that are investing in kind of infrastructure have a much shorter time frame than that. So you need to have something that's going to be, you need to go out there and look for a tool that's going to be able to meet your time horizon needs. The second is that, as you saw in our little snapshot, there's a number of different hazards to think about. And you can definitely find tools that do just sea level rise, but they may not do heat. And that, I think the market is evolving, and there's a lot of tools out there that are trying to kind of pull all this stuff in. But you need to be mindful that you may be solving kind of for one specific type of risk, but not all kind of climate risk. And then the third thing I'll say is that Josh is right. Insurance provides a nice market signal for you if you had, because insurance will be able to do their own assessment of the risk. But insurance also is going to price your risk, or if you can buy a product from them that allows you to transfer the risk, that product is that you're paying for has a 1-year time horizon that can be repriced every year. And you may want to start thinking about how to either follow the trends of those repricing points every year. If it were me, I would think about as that trend kind of slightly increases or accelerates, that is telling you that the insurance companies are thinking of that risk as accelerating as well. And that, I think, is a forward market signal, if there is any. But there's a lot of proprietary tools out there that exist for different types of investors, different types of banks. There are folks out there doing portfolio analysis and climate risk stress testing. That gives you a sense of what the risk is of some of the assets that you're holding, not the assets you might be investing in. But you have to kind of go out there and dig around a little bit.
Well, great. One question to dive in a little bit further on the data and analysis. What recent advances, Josh, this might be a little bit more towards you since you were talking about it. What advances in data analysis do you think is the most helpful or exciting and being used by cities, and if there's any specific examples?
I think the modeling is getting better. We're seeing a number of firms that are starting to really look at some fairly complex modeling where either they're doing multiple scenario kind of big data analysis, or they're doing very, very complex hydrogeologic modeling. So I was talking to somebody at the Natural Hazards Conference yesterday who was saying they're looking at the risk of water level rising in a river, which is very complicated because it's not just rainfall. It's, it starts to get into some of the political issues of do they open the dam or not? And so the modeling's getting better because the computers are getting better and the technology is getting better. The science is getting a little bit better, but we're looking for the next big jump in that.
Great. Thanks. And Stacy, from the Climate Lenders Guide perspective, what's you think the biggest barrier from getting different organizations, especially infrastructure banks, to do more of this? Is it inertia, or is there something else?
I don't think it's inertia. Well, I don't think it's inertia per se. I would say that when you talk to banks who are not coming to the climate conferences or in the kind of world of climate finance, they tend to think of climate change in the category of their ESG work. And climate risk is not ESG. ESG, environment and social governance standards and things that infrastructure banks do around ESG are first and foremost framed as what does your project do to the environment, not what does the environment do to your project. The thing that I think, and there's actually kind of growing awareness and let's say kind of light bulbs going off in a lot of these banks, the growing awareness that climate risk is a credit issue, not an environmental issue, is starting to kind of come to fore. And you know, the real, I would say, the next step challenge once a bank kind of says, oh gosh, this is a credit issue, and oh gosh, we have a lot of assets, let's say in Houston, how is that going to kind of impact our overall financial performance? The next step is to really figure out what are the data and analytics that they need to identify and quantify those first two parts of that risk management process in the first slide I had. That's really the kind of the nuts and bolts of what needs to be integrated into the credit analysis. And then from there, the management discussion is much more, it's a very dynamic discussion. I will make the point also that, you know, and Josh kind of alluded to this in one of his comments, but, you know, good infrastructure is the combination of good planning and good design and finance. So finance is one component, but usually not driving it. It can influence the ability for that piece of infrastructure to be resilient, but oftentimes the projects that come to an infrastructure bank have been designed by engineers or, you know, or city officials or state officials. There's been a lot of work that's gone into putting that plan together before the financing, let's say, strategy has even been thought about, or the financial institutions have even been engaged. So, you know, I see this as kind of being three legs of a stool. You know, there's the planning side, there's the design side, and then there's the financing side. And if the financing includes some public financing, there's also, you know, PPPs or blended finance approach. But the banks themselves are starting to think about this. You know, those banks are starting to think about this as a credit issue, are really starting to think nuts and bolts. How do I understand this from a revenue, asset, and cost perspective? And then how can we together, the developer, the public side, us as a financial institution, come up with the right management suite of options, including insurance, but also probably resilient design and other things. So.
Let me add one thing to what Stacy said, because I think what she said, and an alibi to that is it's not just your physical asset that you own that's the credit risk. It could be your supplier value. In a global supply economy, what's being manufactured that feeds into your supply chain and where you sell your product can also be impacted by climate change, and that can affect your bottom line.
Well, I think that's a great place to end, in that there is no one simple solution. We've had a very diverse group of people. I'm sorry we couldn't get to everyone's questions today, but that there are many pieces that need to be fixed as part of this giant puzzle. So thank you, Stacy and Josh, so much for sharing your expertise. We will share the slides and the webinar on the Green Bank Network website, greenbanknetwork.org, and thank you everyone for joining.
Thanks, Sarah.
Thanks, Sarah.
Bye.